Right, so a good evening to everyone here. I'm Ikai from FSMOne. So welcome to this evening webinar. All you need to know about investing in Japan's market. So we all know that Nikkei 225 closed at 39,098.68 on 22nd February 2004 this year. Is to set a new all-time high since 1989. So subsequently, it went on to break the 40,000 mark. So this rally is not a coincidence. The alignment of many factors, like corporate reforms and supportive monetary policies, give investors the confidence to enter or re-enter the Japan market. So the question now we have is, have I missed the boat? And the good news is, no. We believe Japan still have a long runway for growth, and furthermore, the growth is supported by structural factors and not market cycles. So this sets the foundation for Japan to rise even higher. So this evening, I'm very privileged to have Olivia Lee, Client Portfolio Manager from Eastspring Investments, and Sean Park, Investment Specialist at BNP Paribas Japan Small Cap, to share with us, how they are capturing the opportunities for growth in Japan right now over the course of tonight. So if you have any questions along the way, feel free to put them into the Q&A box, and both speakers will get to them at the end of their presentations. And stay tuned to the end of the webinar for present supplies. So without further ado, let me pass over to Olivia to start the webinar going. Olivia, please.
Thank you, Kai. Welcome, everybody, and thank you for your time this evening. I'm just going to share my screen to bring up some slides. Hopefully, you can now see that.
Yep, we can see your slide.
You see that, right? So, yeah, so Japan's been a hot market now for 12 months or so. This year, we've seen more of the same from last year. You're right, Kai. The number one question I get at the moment from clients around the world is, have we missed the boat? Is there more to go for? Let me give you the conclusion up front, as we think maybe the easy money has been made in the last sort of 12 months, but there is more to go for. And a lot of the structural tailwinds that I'll talk about in a minute are multi-year tailwinds, and they're going to be here for many years. So if you're a medium to long-term investor over the next sort of 3 to 5 years, I would expect Japan to continue to deliver pretty strong returns. And that's predicated on better corporate profitability and stronger demand for Japanese equities from investors around the world. I'm going to jump through my slides to the end, which is where the sort of macro section is. And I'll split my presentation into two. I'll do 10 minutes on sort of the investment case and some thoughts around what's going on at the macro level and some of the drivers of corporate profitability. And then the second half, the following 10 minutes, I'll talk about the fund, the team, and how we are positioned and how we make money for clients in Japan. So starting with the outlook, the long-term investment case, as I said already, is intact in our view. There's 3 tailwinds. The first is that we've got corporate reforms going on, and we expect these to continue. Corporate management teams that we talk to in Japan are more willing to instigate changes than at any point in the last sort of 20 years. We've been running money in Japan since 2006. So that's an encouraging sign that CEOs and CFOs are willing to restructure their businesses, focus on sort of higher profitability areas, and that's encouraging for equity owners. The second tailwind is a move out of deflation towards an inflationary environment. Japan has been beset by deflation for 20-25 years. That's bad for investment. That's bad because people tend to sit in cash. That's changing, and COVID was really the catalyst for that around the world. But of all the countries in the world, I think Japan had the most to gain from a little bit of inflation, and we expect that to continue. The reason it's a good thing is it's good for consumption. People get paid a bit more, so they spend a bit more, but also corporates can actually put up their prices, which means margins can be defended and actually increased in some cases. The third tailwind is we expect a stronger CapEx environment. Capital expenditure in the last 10-15 years hasn't been great in Japan. Company management teams haven't had the confidence to invest. But now with reshoring, friendshoring, some of the geopolitical tensions between China and the US, Japan is really well placed to benefit from that. And you're seeing a bigger urge from company management teams to invest for the future in technology and things like that. And that's positive for growth, positive for inflation. So those are the three big tailwinds. You'll see them in the newspapers every week. Most other asset management houses, our peers, will be talking about similar things. But if you are going to invest in Japan, those are the three things which are going to drive returns and interest levels over the coming years. In 2024, we're already up sort of 15% in Japan in yen terms. But there's a few things I think that can drive returns from here. One is a better pricing environment for companies, which I've talked about. Another is more share buybacks and additional corporate restructuring, which will be better for return on equity. We've just had another round of positive wage growth in the annual shunto, which is the trade union negotiations. That's come in at a similar level to last year. That's very positive. If people feel like they're getting paid more, they'll probably spend more if they're seeing more money in their pocket. The big thing last week was the normalization of monetary policy from the Bank of Japan. So Bank of Japan have had negative interest rates and yield curve control for 6-7 years. The Bank of Japan is now on a path to unwind those abnormal policies. We think that's a good thing. They're not suddenly going to tighten monetary policy super quickly, and interest rates are going to rise to 4 or 5% like they have in the US. So currently, monetary policy in Japan is normalizing, but it remains pretty dovish, and that's positive for the underlying economy. One thing which has changed in January this year is they've relaunched the NISA program, which is a tax-efficient investment vehicle for retail investors. These guys have been sat in cash for many years. They've been selling down their equity holdings, but we think that could be a catalyst for retail investors to come back to the market. It's early days, but with inflation at 2, 3, 4%, that really focuses the mind of retail investors as to whether they want to hold cash. Foreign investors, they're continuing to increase weightings in their portfolios. I speak to clients in America, Latin America, Europe, and Middle East and Asia, across the board and across client types, from retail all the way up to sovereign wealth funds and institutions like pension funds. They're all looking to increase their weight in Japanese equities because they're buying into the story. That's positive for the asset class. One thing that has changed, I think, in the last sort of 3 or 4 months is I'm starting to see a bit more interest in fundamentals, so positive cash flows, balance sheet restructuring, P&L improvements. So the market is moving less on factors, less on top-down macro topics. So I do think as a stock picker that we're bottom-up stock pickers, the market is becoming a bit more favorable. And that doesn't matter if you've got a growth bias or a value bias. I think it is becoming a bit more of a stock picking market, and that's a positive thing for investors. I'm just going to show you a few charts now. I'm going to whittle through these quite quickly just to sort of back up what I've said. The first chart here, look at the left-hand side. It shows price to book, which is a valuation metric of Japan versus other markets globally. This data is as at the end of December, so Japan has moved a little bit, but it's probably at 1.5 times price to book today. It's still cheap relative to Europe, where there are no structural tailwinds at all, and it's much cheaper than the US, where arguably that market is trading on very rich multiples given the tech and AI rally we've seen in the last sort of 4 or 5 months. So Japan is relatively well placed, I think, on a valuation ground compared to other regions. Even compared to itself, it's just above its 10-year average. And I would argue with all the structural tailwinds in place, Japan deserves to trade on a premium to where it has done in the last decade. Corporate margins have improved. Back in the 90s, they were wafer thin. You'll see here this chart shows in the 90s they were 2-3%, pretty paltry. Japan was notorious for investing poorly, and profitability wasn't really a focus at that point in time. But things have changed since Shinzo Abe came to power in 2013. Corporate reform has been on the agenda of the government, and we've started to see company management improve their margins, improve profitability. But margins are still below where they are in the US. US margins are 15-16% at an operating level. So Japan has further to go. And with the corporate reform taking place, selling underperforming business units, allocating capital more efficiently, returning excess cash to shareholders, I do believe that profitability can improve over the coming sort of 3 to 5 years. I said earlier on, the first question I get asked by clients is about whether the easy money's been made and they've missed the boat. The second question I get is often about the yen. What happens? What's going on? How does that affect our investment? Well, quite simply, the yen is at a 20-year weak level. It's weak almost entirely due to the interest rate gap with the US. And we do expect over the next sort of 1 to 2 years that interest rate gap to close as the Fed probably loosen policy and cut rates, and as the Bank of Japan starts to tighten policy, even if it's incrementally. So therefore, you'd expect the yen to start to mean revert back to a longer term average. We use $120 yen in our models. We have 60% upside to our price targets, so we're not scared of a bit of yen strength from here. Yes, a weak yen helps exporters like autos, manufacturers, some of the tech companies. But in generally speaking, Japan is a cyclical market, and if we see a positive yen, is not necessarily a bad indicator for the market. You could see some volatility if the yen moves quickly, but over the next 1 to 2 years, we would expect to see some sort of reversion. On corporate governance, there's a lot of data on this chart, but on corporate governance, the bottom left-hand chart is the main one to look at. This is some work done by Citi Investment Bank in New York. They looked at the ROEs, so the return on equity, the profitability of Japanese companies relative to the valuation multiple, in this case, price to book. And you'll see the gray dots, which are all companies which have less than 8% ROE. They all trade up roughly around 1 times price to book. Some a little bit lower, some a little bit higher. What you'll see, though, is that if companies can actually move up to a higher ROE level of above 8%, you start to get a meaningful re-rating in the stock price. And this, in a nutshell, is the story for Japan. If corporates can improve their ROEs and can improve their profitability, there should be a re-rating, and that should support Japanese equity prices going forward. A couple of topical charts here. One on the left is wage growth. We didn't see any wage growth in Japan for 20 years. Last year, we saw the first round of wage growth increases. This year, we've seen another 3 to 5%. That's positive. That's given the Bank of Japan confidence that inflation is becoming a bit more sticky. We're starting to see service price inflation in Japan as well, rather than food and energy inflation. That's good. That means it's, to a degree, self-sufficient, self-sustaining, and hopefully it will create a virtuous cycle for growth. Travel and inbound tourism is another area we get asked about a lot. Tourism didn't used to be a big part of Japanese GDP 20 years ago, but as of today, it's around 1.5 to 2%, and we're starting to see inbound tourists back towards pre-COVID levels. The key is to see Chinese tourists come back because they used to be the biggest spenders, and we're starting to see that this year. So that's encouraging, and that's supportive of sectors like the hospitality and retail areas. In our portfolio, we have a 35% exposure to small mid-cap stocks. This is because we see a valuation opportunity. I'll come on to how we screen the universe in a minute. But quite simply, we find lots of opportunities in this mid space at the moment. That's because they haven't really performed. Certainly in the last 4 or 5 months, it's been large cap stocks which have done well because there's been a lot of money coming into ETFs, especially the Nikkei ETF. So small caps trade at a record discount to large caps. So I do expect lots of valuation opportunity there for us. And as I said, we have a 35% exposure in those names. They are cheaper. They are less well covered by the sell side. And they arguably have more leverage into the corporate reform story. There's more, I guess, potential for restructuring, returning excess cash to shareholders. So it's quite an exciting area of the Japanese market. And we're pretty happy with the exposure we have there. This is a chart which shows one of the prime messages I gave is that ROEs have improved in the last 10 years. The red bars show ROEs at Japanese companies back in 2012. And then since Shinzo Abe announced some of his corporate governance reforms, we've seen ROEs shift to the right here, and the grey bars show where the ROEs are as of now in 2024. So the sort of the average has gone from 4 to 5% up to around 8 to 9%. So it's a positive direction of travel, and we do expect with those three structural tailwinds I talked about, especially corporate governance reform, we could see ROEs continuing to improve. And arguably that isn't priced in to the market as of yet. I talked about retail investors earlier on with the NISA program. This chart shows quite clearly over the last 30 years that retail investors in Japan have sold down their own equity holdings and have invested abroad. Arguably, that's been the right decision over the last 20 years, but things have changed. The market's now much stronger. There is much more structural underpinning to the investment case. So I do expect retail investors in Japan to maybe reverse some of that over the coming years. Foreigners are still continuing to buy. That's shown by the blue line, and that remains pretty strong. Finally, on sort of the macro investment case charts, I just wanted to point out a little known fact is that the chart on the left-hand side here shows EPS growth in Japan, the US, and in Europe. The red line is Japan. EPS growth has been stronger in Japan over the last 11, 12 years than the US. Now, the US has been the only game in town from the equity market perspective in the last 10 years. Japan arguably has had better earnings growth, but it hasn't been priced into the market. So the opportunity is there for that to continue. And from an investment point of view, a lot of investors I talk to globally are reducing their US weights in their portfolios and allocating to other areas, such as Asia, such as emerging markets, but also for sure, single countries like Japan. And even India, although that's a very expensive market in comparison. So Japan has delivered decent earnings growth, and it can continue to do so as these corporates reform along the lines I've already mentioned. Okay, I'm going to move on to the second half of the presentation. I'm going to just talk about the fund and how we run money. So we've run money, long-only money in Japan now for 17 years. Over that time, we've delivered 3 to 4% of outperformance relative to the MSCI Japan per year through a cycle. And we've done that by sticking to our investment process and investment philosophy. So we haven't changed how we've invested over that time. We're very, very disciplined to our contrarian approach. We believe it works. We believe it works well in Japan, and we continue to do exactly as we have done in the last 17 years. The track record and the process has been stress tested in phases of bear markets and bull markets, phases of value, phases of growth, but through a cycle, we've delivered reasonable outperformance in yen terms. You should look at us as a contrarian investor. What that means is we're looking for assets that have derated versus the market. So they are outlier stocks, but where on our analysis, we believe the market's getting that wrong and the company can recover earnings back to a longer term trend level, which is sustainable. You get periods of mispricing at a market level, but you also get them at a stock level. And these are driven by behavioral biases of the market and of investors. The biggest one is fear. The other one is short-termism, so where you look at just the near-term news and extrapolate that into the long-term. Quite often, if you're a long-term patient investor, you can exploit these periods of mispricing and deliver outperformance. At a market level, we saw in March 2020, because of COVID, the stock market collapsed by 20%, purely based on fear. I guess we all wish we could go back 4 years ago and put more cash into the market at that time. But that's when it feels wrong and it feels hard, that's the time to put money into the market. And it's the same at a stock level. You need to find stocks that are derated, but where actually the fundamentals are actually okay. And that's what we've always done. So yeah, we are a contrarian investor. We build a portfolio of 35 to 45 stocks, so it's concentrated. We hold these stocks for on average 3 to 5 years, so we're long-term patient investors, and we invest across the market cap spectrum, as I mentioned earlier on. And currently we run about $3.5 billion on our desk. The Japan Dynamic Fund, the one we're talking about today, is the flagship, and that's about $3 billion with money from clients across the spectrum and around the world. The team that runs the fund, you can see here, we're all based in Singapore. We've always been based outside of the market. I think if you're a trader or a short-term, some momentum investor, being based in Tokyo might make sense, where you're a bit more sensitive to short-term news flow and rumors. But we're fundamental based. We build portfolios from the bottom up. We spend a lot of time building those valuation models. So being outside of the market for us is definitely not a disadvantage. In my view, it actually is a slight advantage because it gives us a bit of peace and quiet to focus on the bottom-up opportunities. Meeting company management is a big part of what we do. So we do meet CEOs and CFOs here in Singapore, but we also travel to Japan to talk through their strategy and their businesses. The team has always been quite small. We have 6 of us. It's designed that way because when you have a bigger team, often you end up with sort of factions appearing. You don't have a good quality of challenge and debate. So we like the fact that we are generalists. We're not sector specialists. We don't need an army of analysts covering every stock in Japan. Yeah, that's led to the outperformance we've had. The team aren't also Japanese. Don't worry. Avilo used to live there. He's fluent in Japanese, used to work for Fidelity. Max lived there for 15 years and is married to a Japanese lady. Sam did his MBA there. Charlotte joined 18 months ago from Japan, where she worked on the sell side for Goldman's and is fluent in Japanese. So as a team, we are experts in this space. We know the market well. We understand the language and the culture. So that's an important thing. Just conscious of time, so I'll just touch on a few extra slides and then I'll hand over. So in terms of our investment process, there's 4 stages. Very simple. The first one is where we screen the market, 2,500 stocks. We screen those for 1 standard deviation cheap relative to the market, relative to history. So we have a pool of about 100 stocks each year, which are outlier stocks to actually go and do further research on. Of those 100, we probably have 10 good ideas a year which go into the portfolio, and that's predicated on the fundamental analysis we do, where we build a research model and have a valuation target. We build the portfolios as a concentrated structure with 35 to 40 stocks. Typical position is between 1% and 6%. 6 would be the maximum position size. 1 would be where we are actually increasing exposure. We don't wait for our stocks to reach price target. We do actually trade every day. We trim those that are working well, and we add to the ones that are laggards. Again, that's helped, I think, outperformance over the time, and that removes a human bias in investing, which is the common one of falling in love with your stocks and falling in love with your own ideas. So it's a very healthy, disciplined way of running portfolio construction. In terms of portfolio positioning, I'll just finish on this slide. We're fully invested in Japan. The sector exposure you can see on the right here shows that we are overweight global basics, which is material names and especially chemical names, which have been very weak on sort of China macro news in the last sort of 6 to 9 months. There's good opportunity there, and we've been adding to names like Sumitomo Chemical. Domestics has increased in the last 12 months as well, and the portfolio has shifted, I think, more to a balanced positioning. We used to have lots of exposure in financials and autos, but they've done very well in the last 12, 18 months, and we've reduced exposure there and reallocated to laggard areas of the market, such as domestics. The one area which you'll notice here is somewhat contentious is the small underweight to technology. We're a value-based investor. We don't chase momentum. We don't chase very high valuations. So there's some good tech stocks in Japan, especially in the sort of semiconductor chain, but they're often very expensive, priced to perfection. We find much better valuation opportunity in the tech space in areas such as Panasonic, NEC, and Ricoh. So some of the older technology names which are restructuring their businesses and hopefully will deliver better performance for investors through profitability going forward. The top 10 is quite concentrated on the left-hand side. You'll see some of those names there. I'm happy to take any questions at the end if you have any specific points on those stocks. But I'm going to finish my presentation there and hand back to Kai.
All right. Thank you so much, Olivier. Okay. Give me a moment, yeah. Let me do some adjustments. So, right now I'm going to pass over to Sean. Sean is the investment specialist from BNP, and then he'll be touching on from his perspective. Sean, can I pass over to you, please?
Yeah, sure. Hi, all the journalists in Singapore. My name is Sean Park from Tokyo. I'm an investment, as introduced, I'm an investment specialist for BNP Paribas Japan Small Cap. And as today I am now joining from Tokyo. I'm a Tokyo-based, just in case if there's any delay in delivering my voice or my presentation, please do not hesitate to point out. I think Kai will help you all on this. And to share my slides to you, and just to check, Kai, I hope my presentation is on screen.
Yes, your presentation is on screen.
Okay, so then let me for the next 20 minutes, let me start my presentation on the Japan small cap asset class, as well as introducing some of the opportunity that lies in the small cap space, in the Japanese small cap equity space. As Oliver has mentioned about some of the recent market sentiments, where large caps, like for example Nikkei 225 Topics Index has been attracting strong momentum, and it is true that on nowadays large caps are pretty much attracting attention. I think that now the next opportunity in terms of the growth side as well as the valuation side, where the stock is undervalued. From the valuation perspective, I think there's also a great opportunity lies in small cap space. Okay, so for my presentation, here are some of the key points that I want to mention during my presentation about the BNP Paribas Fund Japan Small Cap. It's a bottom-up talking about the investment, a very original investment philosophy created by the lead portfolio manager, where we focus on the valuation and the earning growth of the Japan small cap companies, where we consider the valuation expansions and earning growth as a source of alpha to outperform the benchmark. So very simply speaking, we conduct a GARP approach, GRP GARP approach, with a very rigorous process of having over 900 company interviews and meetings by the portfolio management team, consists of 3 experienced PMs, where the portfolio positioning is determined with the weight, with a very balanced and also with a strong conviction, considering the liquidity in the small cap market. I think one of the most important factors that you will see the results. We have been engaged in the Japan small cap market over 20 years. So this since the launch of this fund from 2002. So yes, over 20 years. We have been having a great track record, great track record in this universe, with a very demonstrated and stable performance in the Japan small cap space. Very briefly, talking about who I am. Actually, who I am and who we are. Talking about we are a investment manager, a delegated investment manager called Sumitomo Mitsui DS Asset Management, based in Tokyo. One of the major, well-known asset management firm in Japan. And as I said, we have been the delegated investment manager from BNP Paribas Asset Management, who is based in in Paris since the year 2003. With over 30 years of experience by the lead PM, who's been in the same position for the past 20 years. With the biggest AUM in the UCITS Japan small cap market, with the AUM of 679 million in USD. So here's the just introducing our team, the portfolio management team. So again, Shunsuke Matsushima, he's been in the position of lead portfolio manager since the commence of the delegation of this fund, which is also being supported by the two young deputy managers by supporting the lead PM, the investment decisions by lead PM, and also. We consider that the most important thing for the Japan small cap market, which Japan small cap market characteristics, we consider that the company meetings and the research conducted by the PMs themselves is the most important source of alpha. So these three will conduct approximately around 250 to 300 plus company meetings and interviews, which creates around 900 plus to some with approximately up to 1,000 company meetings as a team on annual basis. Now, the next slide shows our latest holdings as of February end in 24. I think if you focus on the top 10 holdings, which is on the left side of the presentation, comparing with the very well-known Japanese large cap companies like, let's say, Toyota, Sany, or with the greater awareness, I suppose, or I assume that most of the companies incorporate into the portfolio are not really well known to you investors in Singapore, or most of the investors in outside of Japan. But with our conviction, this is a background of our conviction that even though such lacking awareness names in the small cap universe has been having a very strong and stable performance, this long-term performance against not only against the Russell Nomura small benchmarks, typical a small cap index, but against the Nikkei 225, the larger cap index as well, recording positive 190.78% of return, and of course outperforming the broader benchmark in Japan. So for the next a few slides, I'm going to focus on why go deeper into why the Japanese small caps could be attractive to you investors, and also talking about our fund positionings. So basically, Japan small cap it's a very broad, diverse universe with over 3,500 companies listed in the market. It's actually the second largest small cap market in the world. The first one is US, and it's Japan is the second, where there's significant inefficiencies as well as the mispricing opportunity lies due to the under-researched universe, comparing it with the large caps and the other asset class like US equity and Euro stocks. And also we can also talk about the valuations in the small cap space against large caps. And also talking about our fund positioning briefly, as I mentioned in the beginning of the presentation, we consider that, of course, we also take into consideration about having a overweighting or strong positioning on the sectors that we think it's more promising, such as on the left-hand side, global technology-related sectors. And in this Japan small cap space, it's more related to the small cap companies, small cap manufacturing companies. But we also think that as explained about how cyclical the Japanese market is, we also believe that having a good balance between the external oriented or the cyclical sectors as well as having allocation to Japan domestic factors, and considering the balance between the two exposures I mentioned is the important key to have a stable outperformance in the Japan small cap space. So skipping into how the Japan small cap universe is under researched, you can see on the left-hand side graph that the topics, the sell-side analyst coverage comparison with the small cap indices, Topix Small and Russell Nomura Small Cap against Topix 100 or Topix Mid for 100, you will see that there's a significant low coverage of the small cap space, which implies that there's a less consensus for many smaller cap stocks, and of course a large information gap, and also inefficiency as a potential in this small cap market. Also, the expected increase in the sell-side analyst coverage is one of the key points that I want to focus on today, where, as mentioned from recently, the global investors have been showing a stronger interest into into Japanese equity market as a whole. Now, not only the domestic investment banks, the sell-side market size, but also some of the global firms, global sell-side companies expanding or reconstructing the Japanese equity coverage. So we hope that supported by the momentum or growing interest in the Japanese equity space, this expansion in the sell-side analyst coverage were one of the key factors to underpin the valuation expansion going forward, especially for the small cap companies. So, talking about another aspect for the Japan small cap asset class, you can see that as I mentioned, the large cap companies, first of all, their business is more related to the global business in terms of their business portfolio, which you can see that. For smaller cap companies, there are a number of companies that their main business portfolio lies in Japan domestic basis, which implies a very lower standard deviation from long-term to ultra long-term, from 3 to 5 years, 5 years, 10 years, comparing with the larger cap indices. So this implies that I think you will unlikely to see a very global investment sentiment. Global investment capitals lies in the number of such global huge amount of investment or short-term players, if I could describe. The number of such investors are typically lower than that of the large cap space. So I think that which gives more stability, if I could describe, in the smaller cap asset class, which is one of the strength of the Japan small cap. Maybe some of the investors in this webinar, I have kind of a typical image or typical point of view that the Japanese company to the Japanese companies, that they are more conservative, talking about the corporate cultures, and they are more maybe you can see them as more conservative, having more conservative corporate cultures, where there are less agile to this with the innovative changes among in the let's say in this world. But I think for Japanese smaller cap companies, maybe comparing with the large cap companies, that is somehow a myth that lies or some kind of aspect that is misled by the images captured by the large cap companies. There are, at least comparing with the large cap companies, our conviction is that they are more flexible in terms of their business cultures, and their business models are much more unique than a typical existing business oriented large cap companies in Japan. Showing you the EPS growth over the long term, and for the next slides over the short term, you can see that small and mid cap earnings per share growth is outperforming the large cap, both on shorter term to a super ultra long term, 10 years. So on the left side, I'm showing you a 3-year EPS growth, and on the right side, it's a 5-year, outperforming that of the small and mid caps, outperforming that of the large cap. So from here, giving you some of the attractive themes that the fund has been focusing, and fund is focusing now. One typical area is a clean energy and decarbonization, where the government is now trying to make the energy transitions from the traditional fossil fuel related electricity planting to more sustainable ones, where to meet the carbon neutrality, where by 2030, so in the next 7 years, the government is trying to increase the percentage of clean energy to 36 to 38%. And now, having seen the outperformance of the traditional energy sectors, I think that there are I think that the momentum is a little bit weaker comparing with what it used to be in the past 3 years. But we think that supported by the government, the structural changes and the support from the government, we think that this change in the energy sources for the Japanese society would be a very attractive investment target in the Japan small cap space. Also, talking about the recent corporate changes, I think that I think Oliver has mentioned about the relationship between the ROE and the price to book ratio, and it's true that there are the companies on a larger cap side that has been gaining the momentum in the past 2 years. But sticking into the more smaller cap space, where the market cap from JPY 10 billion to 100 billion, we can see talking about the sustainability, how sustainable that the companies can improve over the longer term, improve the ROE and or more the shareholders' return. Particularly speaking, the percentage of the stocks with the price to book ratio is below 1 times, and the ROE of above 8 times, or maybe more sustainable, more quality stocks. These companies more rely on the small cap space than larger cap space. If you look at the red bars in the graph. And also valuation comparison are also important. This is the past 10-year EPS index price and EPS growth valuation with comparing with Topics all cap, and Topics which is an all cap SP 500 and European equities. You can see that the Topics small significant difference between the price increase and also the EPS changes. So we think that more chances are to be incorporated with and also that the opportunity from the valuation perspective lies in a smaller cap space than large cap. And so this page showing introducing you how how we have been engaging in the small cap market. We by the portfolio management team, it's a value to growth strategy which creates where we target the undervalued companies that has a bigger potential in the earnings on the company's earning growth, where we seek both the valuation expansion and also the growth acceleration, and we focus on that on what kind of catalyst that makes the typical value stocks to transform into growth recognized stocks in the market. The typical example is that this is an investment case which was a model case for the lead PM to generate the idea of this investment philosophy. So talking about Murata Manufacturing, now it's considered a very large cap stocks, a large cap company, but back 30 years back, it was considered a small cap value companies with a price to earnings ratio of around 12 times. But in the next 2 years, led by the catalyst of the expansion of mobile phone, the 3rd generation mobile phone. You can see that the valuation expansion was incorporated into the price with JPY 8,000 and a PE ratio of around 80 times. So what I want to stress here is that in terms of the number of opportunities, as I said, right now there are around 4,000 names listed in the Japanese market and Japanese stock market. And according to our definition of our small cap, which is the companies with market cap of less than 450 billion yen, I think that there are many companies that has a potential to transform into from such small value companies to a larger market cap growth companies. So that is the point where we focus when we make an investment in this fund. For the next 2 slides, I wanted to share with you some of the investment cases done by the fund. But let me pass that to Q&As if you want to go deeper into the companies and our positions as well. And talking about our fund performance, we have been outperforming the benchmark over the years with the great performance going through the turbulence and a significant market environment which affected by the multiple rate rise in US. We have been showing a good track record of outperforming the benchmark. And for some of the backgrounds that I want to introduce you as our current positioning, talking about the balance and also some of the overweights in the sectors. What I mentioned are some of the manufacturing companies that has more growth potential, and also some of the companies that has a very unique potential in the Japanese domestic side in terms of sectors like a retail trade and also some of the companies that provides provides technology supports to such manufacturing companies such as factory automations and so on, where we where we have been underweighting the industries like that we consider more less growth potential, like banks, foods, is our positioning. And particularly speaking, the performance for this year, these technology manufacturers that we have been invested with lower valuations from price to earning ratio of 10 times to 20 times, we are starting to show a good performance after some turbulence seen in 22 and also in the beginning of 23. And yet we seek for our valuation targets that we determine to liquidate the position is still ongoing, and we think that now that these technology companies led by the investment team of generative AIs and the investment development to and momentum to the generative AIs are also contributing to the fund performance. And as I said, the balancing, having said that, I know it's a very small cap is a very niche market, and also particularly when there is a economic turndown on global basis, we think that it is somehow exposed to a bigger risk. So what I want to stress here is that, especially the left-hand side graph, we always consider the balance between in order not to overbet on certain sectors or certain exposures to the cyclical and defensive. Some of the changes for the past 1 year of having always considering the balance, considering the global economic momentum as well as the market sentiment. So that is what I want to stress in this slide. Last but not least, I just want to, in our opinion, I would like to stress out that I agree with Olivier that Japan remains as an investment destination in 2024, but our conviction lies in more on a small cap space, poised to outperform that. Having a small cap allocation will add you some diversification to your portfolio. As introduced, with a very with less volatile characteristics than compared with the Japan large caps. And also our again, let me mention some of the fund outlook as well as our positioning to investing into undervalued growth opportunities, which represented by our positioning on the technology as well as some of the Japanese specific catalysts, which is conducted by the Tokyo-based team with more opportunities to find out, to detect the opportunities in the Japanese company, among the Japanese companies. Okay. Okay, maybe I have exceeded a few minutes, but this will be end of my presentation, and I will get back the lead. I will bring back the lead to Kai.
Thank you so much, Sean. It was a very generous sharing out from your side, and it's okay. I guess we all learn a thing or two from this, and we are fine with the extra 1 minute or so. All right. So we shall now move on to the questions and answer segment of this tonight webinar. I have seen quite a few questions that our attendees have typed in the Q&A segment. So I guess I just want to start the tone. So for the first few questions, I believe it was more targeted towards Oliver, whereby questions are coming in during your presentations. Do you want to take on the few questions?
Sure. Yeah, I can do that. And there's been a few questions on the same topic. So let me just pick a couple of those bigger topics. So the first one is the yen. I did show a slide that showed the yen at the sort of 20-year week level. If you look at the other line on that chart, it shows the competitiveness of the yen, and again, that is a 20-year high. So if you're an exporter in Japan now, you're definitely benefiting if you're exporting globally. That has been a tailwind in the last 12-18 months. It's definitely been a tailwind year to date. But our conclusion is that a reversal of that towards a bit more yen strength isn't necessarily a bad thing for the equity market. It might cause some volatility. It might cause some changes in composition in people's portfolios between, say, exporters and autos versus domestics and importers. But generally speaking, if you go back over history, the Japanese market's been cyclical, so a stronger yen with pro-cyclicality has not been a bad thing for the equity market and equity returns. To give you a flavor, we've taken profitability in auto companies and banks because they've rallied really well, and we've redeployed into domestics and some of those material names. We use a 120 average dollar-yen rate in our models. We're currently at 151. So we imply a yen strengthening scenario in our valuation work, and we still have 60% upside to our price targets. So we're not scared of a bit of yen strength. If and when it happens, as I said earlier on, I think if the interest rate gap does close a little bit with the Fed cutting rates second half of this year and the Bank of Japan getting a bit more hawkish, then you will start to see the yen strengthen. But I'm not a macro expert. We spend 99% of our time looking at stocks, but we would assume in our modeling a longer term average level, and that would imply a bit of strengthening from here. The other question was around ROEs. One of my charts I showed is that ROEs have improved in the last decade, but even at 8 or 9%, they're still way behind the US. Now, there's a reason for that. US companies, they have a huge amount of financial re-engineering. They're very innovative. You probably want some exposure to the US in your portfolio. I'm sure you all do. But my argument would be that Japan is on a trajectory of improving ROEs, and that can continue over the next 3 to 5 years with all the corporate reform going on. And that's probably the main driver. It's not necessarily moving to an inflationary environment. As an equity investor, if companies can improve underlying profitability by allocating capital more effectively, by cutting costs, by selling off underperforming business units, that's a good thing. That's a great thing for shareholders, and that's probably going to drive a re-rating for the market going forward. I would caution that whilst at an aggregate level, I do expect ROEs to improve, not all companies are going to embark on this journey. And if you look at small mid-cap companies, not all of them have reported to the Tokyo Stock Exchange on what they're doing to address balance sheet inefficiencies. So I do feel it's very much a stock picking market, and Sean would agree with this. There's some companies that are not going to go out along on that journey, but there are some companies that are, and we can pick and choose which ones have the most leverage into that corporate reform story and can actually improve ROEs going forward. The last question I think I'll just touch on is semiconductors. Do we have exposure in our portfolio? We do have one company called Sumco. It's a wafer manufacturer. We bought that last year on some of the sort of bottoming out of cyclicality in the semi space. We bought it quite cheaply, and that's done very well for us in the last few months, and we've started to sell it already. Normally, we hold stocks for 3 to 5 years for our investment thesis to play out. This stock's done well because anything in the semi space looks like it's recovering. Anything in the AI or semi value chain is now trading at pretty big multiples. So things like Advantest, which is a semiconductor testing company, great company, but it trades on 80 times forward earnings now. So for us, there's much better valuation opportunity in other areas of tech rather than chasing that momentum higher.
All right. Thank you, Oliver. So I shall pass on to Sean. In the interest of time, let's take 3 questions at the max. So I think one of the questions will be about the BNP fund. Can I leave you to take a question?
Yeah, so okay, I'm so surprised to see with this many question interest on the Japanese
okay, sorry. Sean, sorry, Sean, I'm gonna cut you for a while because your audio is a bit patchy. Can you say it slowly again? Yeah.
Yeah. So I'm just gonna I was in the middle of the questions, questions.
Okay. Okay, sorry, I'm gonna stop you again.
About our.
Okay, you are.
Okay, so.
Yes, good. That's good.
Yeah, so I think so talking about the number of positions, the recent number of positions in the portfolio, 100, which is 114 as of so in talking about liquidity in the small cap space right now in the underlying market, as more investors are engaging in Japanese larger cap or Japanese top cap space, there has been some we have to admit that there has been some of the deterioration in the liquidity in the space. So yes, with over the past 2 years, yes, it has been actually has decreased. So as we have been maintaining around 120 plus to 130 plus positions. So we are now trying to be more highly concentrated in terms of positions, but considering the liquidity, having a lot of number of stocks is important in the market.
Okay, sorry, I'm gonna stop you again because your audio is getting a bit choppy again. Okay, I think we wait a little while. And then if you are comfortable with, you might want to type out the answer for the question itself. So, but also I guess in the interest of time, we might want to take the last question. So I'm just going to direct both speakers to the last question, all the way down at the bottom, whereby the question is, where is the bulk of the earnings coming from for the Japanese market? And if it's driven by domestic demand, should we not be concerned about a shrinking and aging population? So I will let Oliver take the question first. And then once Sean is so-called back online, I'll let him take over.
Yeah, sure. Okay. let me address the shrinking population question first. Listen, demographics are a headwind, but they're a headwind on a 10, 20, 30-year time frame. Most equity investors in Asia have an average time frame of 3 months. So it's an interesting topic to discuss, and it can have an impact on aggregate demand, but it's outside most investors' time horizon. So if I look at our time horizon, which is 3 to 5 years, demographics don't really come into play. And actually, an aging population with a low replacement or fertility rate, Japan is about 1.2, 1.3. You need 2.1 to maintain a population. Yes, that's a headwind, but it also drives innovation, drives technology, and Japan are brilliant in the sort of robotics and automation space. There's some good companies there. Again, they trade on pretty rich multiples, things like Fanuc. But yes, it can drive innovation. And the key thing for equities or for companies is profitability. And if you can embrace a higher productivity in your company and you can focus on ROE, allocating capital better, that should drive profitability. So I don't think the demographic topic is one that's a real headwind in the sort of medium term. In terms of where earnings growth is coming from, we're not growth investors, we're more value investors, so we're looking for mispricing. We're looking for companies to recover back to a long-term trend level rather than forecasting a big growth rate in year 10 of a discounted cash flow model. That said, the market does feel a bit healthier today to us. Most sectors are seeing sort of improvements in their underlying fundamentals. That's a positive thing. And it's why we've got a bit more balance in our portfolio today than we did, say, 2 years ago, where the portfolio was skewed more to autos and to banks. But yeah, we're not particularly growth investors. Sean might have some better commentary around which industries he's invested in, where there's potential for growth going forward.
All right. So let me pass over to Sean. Sean, are you still with us? I believe you are still with us. You might want to take this question on. Okay, let's wait a few more minutes for the internet to sort of stable down. Okay, I guess due to some technical difficulties, we might have some problems. So let me forward. Hi, Sean. Sorry. Yeah, let's wait a while for Sean.
I think considering the weak internet connection between Japan and Singapore, I think I'd rather answer the questions from the chat on chat basis.
Yeah.
So let me focus that again. I tried to reconnect with my mobile phone. So let me reconfirm all the questions again provided by the investors.
All right. Sean, you give me a moment. Okay, Sean, in the interest of time, we would like, I guess, and all of us here, and Oliver and all of us here would like to hear your opinion on one of the last questions. So the last question, if you can see, is by Stephen Chen. Sorry if I print the wrong name. So the question is, where is the bulk of the earnings coming from? And then if it's driven by domestic demand, should we not be concerned about a shrinking and aging population?
Yeah, so basically, straight to the conclusion, I think it's more the bulk of the earnings are more lies on external oriented demand sectors, and I think that it is we think that it's more promising on such the technology sectors I mentioned during the presentations during my presentation. Where especially on the small cap side, considering as you mentioned, the decrease in the population in Japan, where over the shorter terms, or let's say a nearer term, there should be a more on support from the government, where engaging or advertising or supporting more women's Asian women
population as well as the number of the laborers over 60 years old are expected to underpin the stability of the labor population. Having said, talking about a longer term, I think having the current situation stable, we have to admit that the longer, let's say, the earnings bulk is not on a Japanese domestic side, but on the external side, so the companies that are more global, that they have more business portfolios on a global basis. So with this in mind, I think our positioning on the external demand sectors are determined, where we overweight such companies in the external demand-oriented sectors.
Right. Cool. Okay. Thank you very much. And thank you very much also for being able to resolve any technical difficulties. Once again, I just want to say a big thank you to everyone here for bearing with us of all the technical difficulties and stuff. So and this is the last question that we will take for tonight. So once again, thank you, Oliver and Sean, for the wonderful sharing today. I'm sure everyone here of us have learned a thing or two. And also a big thank you here to all the attendees here who have with us this evening, despite being so late and despite, we started the webinar a bit later than usual. So I hope you find the sharing useful in your investment journey in 2004 and are prepared to seize the opportunities, present in the Japan market. Lastly, we would like to invite everyone to connect with us. On the screen are the links to our various social channels. You feel free to scan the QR code that you're most comfortable with, and we will see you there at our social channels. So with that, the webinar has ended, and I want to once again thank you, Oliver and Sean, for spending their evening with us to share about the opportunities that are present in the Japan market right now. So the webinar has ended, and feel free to leave and have a great evening, everybody. Thank you very much once again.